My name is Fredericks, and for my investment analysis, I'm going to analyze two industries. Each of those industries are going to have 5 companies, and I'm going to analyze each of these 5 companies for each industry over 5 years. And then I'm going to identify the best company in each industry as well as the best company overall. The two industries that I analyzed were the oil and gas industry and the healthcare industry. For the oil and gas industry, we have ExxonMobil, Chevron, ConocoPhillips, Hess Corp, and Marathon Oil. And for the healthcare industry, we have Aetna, Anthem, Cardinal Health, Humana, and United Health. For the oil and gas industry, first we're going to look at economic value added spread. EVA spread tells us what you should make versus what you really earn. A high EVA spread indicates that the company is growing as well as that we have a high profitability with investors' money and we're able to pay them back. And whatever is left over after we pay our investors back can be reinvested into net present value projects. As a company, you want to strive for a high EVA spread. However, as you can see from the graph, most of the companies are consistently in the negative over the 5 years. But the two that I want to focus on are Hess Corp and Marathon Oil. Here I've included 2 pictures from Bloomberg that indicate the capital structure for each company, Hess Corp and Marathon. As you can see, these two have the lowest EVA spreads, with Hess Corp being negative 21.44% and Marathon being negative 15.52%. Even though for all of these 5 companies, they all had negative EVA spreads, these two were the lowest EVA spreads. So we are going to get rid of these 2 companies for our analysis. The goal of management is to maximize shareholder wealth. To ensure that shareholders are getting the return they need for taking the risk of investing in this company, we calculate for the return on equity. A high trend in ROE indicates a company's profitability with shareholders' investments. So not only do we want a high ROE, more importantly, we want a trending high ROE. We want consistency. But as you can see by this graph, the ROEs for these companies not only fluctuate throughout this period, but also show a negative trend from 2011 to 2015, especially ConocoPhillips, which now has a negative EVA spread. Because of this, we are going to get rid of ConocoPhillips for our analysis. Now we're going to look at what's driving ROE. ROE is broken down into ROA times equity multiplier, which is leverage. ROA is further broken down into profit margin times total asset turnover. Profit margin is even further broken down into tax burden times interest burden times operating margin. So overall, ROE equals tax burden times interest burden times operating margin times total asset turnover times equity multiplier. And total asset turnover and operating margin are going to be what you look at to decide whether or not is total asset turnover and operating margin are a good judgment to see if you're a good manager. So after comparing these ratios, we determined that even though Exxon had the highest ROE, Chevron was the best out of this category because of its low equity multiplier. Taking liquidity and leverage ratios, asset efficiency ratios, market value, and the dividend discount model into consideration, ExxonMobil is the winner of this industry because it has the highest level of asset efficiency. They have the only positive return on investment capital with the lowest weighted average cost of capital. They also have the only positive PE ratio and the highest market to book ratio. And they are projected as being undervalued. All these things lead to ExxonMobil being the winning company for the oil and gas industry. Now we're going to look at EVA spread for industry number 2, the healthcare industry, which includes Aetna, Anthem, Cardinal, Humana, and United Health. As you can see, just by looking at this graph of EVA spread, we can automatically decide to get rid of Aetna because it has a negative EVA spread. You never want a negative EVA spread, and since it's the only one that has a negative, it's easy to remove from our analysis. Now, taking a look at ROE, we decide to get rid of Cardinal because of its inconsistency and Humana because it's decreasing. Inconsistency is not good when we're dealing with return on equity because shareholders don't like that they are unsure that they're not going to get their money back. And obviously, we don't want a negative ROE. Now, looking at ROE breakdown between Anthem and United Health, overall, I find United Health better with a higher total asset turnover and equity multiplier compared to Anthem's total asset turnover and equity multiplier. Now looking at United Healthcare's liquidity and leverage ratios, asset efficiency ratios, market value, and dividend discount model. Taking all this into consideration, United Health is the winner of this industry because it has a higher liquidity, they are projected to be undervalued, and United Health has the highest ROE. Now that we've found our 2 best companies for each industry, now we're going to look at ExxonMobil and United Healthcare together to see which one of them comes out as the overall best company. Looking at capital structure, ExxonMobil has the lower weighted average cost of capital. They have the higher return on investment capital, and United Healthcare is the only one with a positive EVA and EVA spread. Based on this information here, United Healthcare is better when considering capital structure. Now, when comparing ExxonMobil and United Healthcare in regards to ROE breakdown, based on decomposition, United Healthcare is the better choice due to its higher ROE, even though it also has the higher equity multiplier. Now looking at ExxonMobil, ExxonMobil has is the most liquid and has the lowest leverage. And in regards to the market value, ExxonMobil has the higher PE ratio and the higher market to book ratio. United Healthcare, when it comes to asset efficiency, United Healthcare is more efficient because of the higher receivable and total asset turnover. Both Exxon and United Healthcare are projected to be undervalued based on the dividend discount model given by Bloomberg. Overall, the winning company for the two industries is United Healthcare. United Healthcare is the winner because it has a positive EVA and EVA spread. It has the highest ROE, even with it having the higher equity multiplier, and they are the most efficient with managing assets. On the next slide, I go into more detail on the company of United Healthcare. United Healthcare Group is classified as managed care. United Healthcare Group Incorporated owns and manages organized health systems in the United States and internationally. The company provides employers products and resources to plan and administer employee benefit programs. United Health also serves the health needs of older Americans, provides specialized care services, and provides healthcare information and research to providers. Here on the screen, I have a picture of United Healthcare's supply chain. To the right, you can see that they have 3 customers, and to the left, you can see that they have 21 suppliers. Since United Health has many suppliers, they are not in danger of losing a profit. If one of those suppliers were to default, as opposed to a company with few suppliers. This is the end of my presentation. Thank you very much.